The Cryptocurrency Launch Blueprint, a strategic guide to building, funding, and sustaining a digital asset. This report provides a comprehensive, strategic blueprint for launching a new cryptocurrency. It moves beyond superficial technical instructions to address the critical, often overlooked pillars of a successful digital asset project: legal compliance, strategic financing, and community-centric growth. The analysis indicates that the launch of a cryptocurrency is less a technical feat and more a complex, multidisciplinary business venture. The current regulatory environment, especially in the US and EU, necessitates a compliance-first mindset. Furthermore, the true value of a decentralized asset lies not just in its code but in the strength and engagement of its community. The inaugural step in any cryptocurrency venture is a strategic one, defining a compelling purpose and outlining a clear vision. This is a crucial phase that lays the groundwork for all subsequent technical and business decisions, and its importance cannot be overstated. A project that fails to identify a meaningful use case is unlikely to gain market traction, regardless of its technical sophistication. A digital currency can serve a variety of purposes. Traditional and cryptocurrencies can function as a medium for the transfer of money, offering a peer-to-peer system that is fast, easy, and inexpensive to use on a global scale. They can also act as a form of alternative wealth storage, a new asset class akin to traditional money that is not controlled by a central bank or financial institution. Beyond monetary functions, cryptocurrencies can support smart contracts, enable data verification, or facilitate smart asset management. For example, Dogecoin was famously created as a currency based on a popular internet meme, while IMPT is a token designed to reward users who reduce their carbon footprints. The vision for the cryptocurrency is then formally documented in a white paper. This document is not merely a technical brief, but the project's core business plan and manifesto. A white paper must be a comprehensive document that provides clarity on every aspect of the project, including its objective, market analysis, development strategy, and tokenomics. A well-crafted white paper serves as a sales pitch for potential investors, building trust and conveying the project's long-term value proposition. A well-defined functional utility is a key factor in determining whether a token is legally classified as a utility token or a security token. This distinction is paramount in the US, where the Howey test is applied to digital assets. Following the ideation phase, the next critical juncture is the selection of a technical architecture. This choice is a foundational one that dictates a project's complexity, cost, and long-term operational capabilities. There are three primary methods for creating a new cryptocurrency, each with its own set of trade-offs. Constructing a unique blockchain. Building a new digital ledger from the ground up. This approach provides the most freedom and control, but is also the most resource-intensive. Altering an existing blockchain. Creating a fork by modifying the source code of an established chain. This is a less resource-intensive option, but still requires significant technical expertise. Generating a token on an existing blockchain. This is the least technical and most common method, which leverages an established network like Ethereum or Solana to create a new token. The cost can be substantial, often reaching into the six-figure range or even several $1,000,000 due to the need for a dedicated team of developers, smart contract experts, and project managers. In contrast, creating a token on a pre-existing platform is a far more affordable option. Simple tokens with basic transfer functions can be created for as little as $5,000 to $30,000, as the underlying infrastructure is already in place. At the heart of any blockchain network is the consensus mechanism, a protocol that enables a distributed network of computers to agree on a single, shared record of all transactions. Proof of work relies on miners solving complex cryptographic puzzles to validate and add a new block to the chain. However, its core drawback is its immense energy consumption, with the Bitcoin network alone consuming a staggering amount of power annually, comparable to that of an entire country. Proof of stake was developed as a more energy-efficient alternative to POW. Instead of solving puzzles, validators are chosen to create new blocks based on the amount of cryptocurrency they hold and are willing to stake as collateral. POS consumes approximately 99% less energy than POW, which makes it a far more sustainable model. Delegated proof of stake introduces a system of representative democracy. Token holders vote for a select group of delegates or validators who are responsible for validating transactions and securing the network. The legal and regulatory environment is arguably the most complex and critical aspect of a cryptocurrency launch. Navigating this labyrinth requires a compliance-first approach, particularly in major jurisdictions like the US and the EU. In the US, a central piece of this framework is the SEC, which regulates digital assets that qualify as securities under the legal standard known as the Howey test. Established by a 1946 Supreme Court case, the Howey test determines whether a transaction qualifies as an investment contract and is thus subject to federal securities laws. The test has 4 core criteria: an investment of money in a common enterprise, with a reasonable expectation of profits, derived from the efforts of others. This has led to recent high-profile court cases against major crypto exchanges, which have affirmed that the economic reality of a transaction, including the marketing and promotional efforts, can be a determining factor in whether a token is considered a security. In addition to the SEC, the Financial Crimes Enforcement Network, a bureau of the U.S. Treasury, regulates businesses that engage in money transmission, which often includes digital currencies. Beyond federal oversight, U.S. states have their own varying regulations, with some, like New York, having stringent requirements such as a bit license for businesses that issue or exchange digital currency. The European Union has taken a different approach with the Markets in Crypto Assets regulation, which establishes a harmonized, comprehensive framework for crypto assets across all 27 member states. MiCA covers a wide range of crypto assets not currently regulated by existing financial law and institutes clear rules for transparency, disclosure, authorization, and supervision. The global regulatory landscape is a patchwork of approaches, from countries with outright bans on cryptocurrencies to those with more progressive stances. A successful cryptocurrency launch requires a viable financial strategy to raise capital and a clear path to providing market access and liquidity. The evolution of fundraising models is a direct market response to the high-risk, fraud-prone nature of early token sales. The primary methods for raising capital are the initial coin offering, initial exchange offering, and initial DEX offering. In an ICO, the project team directly sells new tokens to the public, typically in exchange for an established cryptocurrency like Bitcoin or Ethereum. This model offers low costs and full control for the project team. However, it is the least secure method, lacking third-party vetting and offering no guaranteed liquidity, which makes it highly susceptible to fraud and manipulation. Initial exchange offering is a more structured fundraising method in which a centralized cryptocurrency exchange vets and manages the token sale on behalf of the project. IEOs are considered safer for investors because the exchange's reputation is on the line, incentivizing them to screen projects for viability and credibility. Initial DEX offering operates on a decentralized exchange or launchpad. An IDO merges the open accessibility of an ICO with the instant liquidity of a DEX. Gaining market access and providing liquidity is a crucial step after fundraising. This is primarily achieved by listing the token on cryptocurrency exchanges. The process for listing on a centralized exchange like Binance or Coinbase is a formal one that involves a rigorous due diligence review. Exchanges receive hundreds of applications daily and evaluate them based on criteria such as the project's relevance, team eligibility, and a large trustworthy user base. For decentralized exchanges like Uniswap or PancakeSwap, the process is far simpler and does not require a formal application or review. Anyone can list a token by adding it to a liquidity pool of the blockchain platform being used. The success of a cryptocurrency project extends far beyond its technical development and fundraising efforts. A robust marketing strategy and the cultivation of a loyal, engaged community are essential for establishing a market presence. Core marketing strategies include leveraging social media platforms like Twitter, Telegram, and Discord to build a dedicated community and foster conversation. Content marketing is crucial for attracting and educating the target audience through in-depth explainer videos, tutorials, and educational blogs. Engaging in public relations and partnering with influencers can significantly expand a project's reach and build credibility. Additionally, Web3 native tactics such as airdrops and bounty campaigns can generate buzz and rapidly acquire new users by incentivizing them to complete promotional tasks. A strong community is not merely a marketing metric, it is a core asset that can directly impact a project's financial and operational success. Platforms like Telegram and Discord are central to this effort, serving as channels for announcements, discussions, and real-time support. It is highly recommended to hire a dedicated community manager with experience in these platforms and a deep understanding of the crypto space to effectively moderate and grow the community. For a project to successfully list on a major exchange like Binance, a strong community backing and community trust are considered major criteria. Exchange due diligence teams observe how a project's team interacts with its community to ensure trustworthiness and reliability. The launch of a cryptocurrency is an intricate, high-stakes endeavor that demands a holistic strategy integrating technical, legal, financial, and community-building efforts. The analysis of the entire process reveals that these elements are not independent but are deeply interconnected. The prevailing legal landscape, particularly with frameworks like the Howey test in the US and MyCA in the EU, dictates that a compliance-first approach is non-negotiable. Furthermore, a project's long-term success is not just determined by its code but by its ability to foster a loyal and engaged community. Based on this synthesis, a clear, actionable roadmap is recommended for any aspiring founder. Define, establish a clear and compelling use case and utility for the cryptocurrency. Document, develop a professional white paper that meticulously outlines the project's vision, technology, and tokenomics. Consult, engage specialized legal counsel early in the process to conduct a Howey test analysis and plan for compliance with federal and state regulations. Develop, select the appropriate technical architecture and develop the smart contract, ensuring a mandatory security audit is performed to mitigate the risk of immutability. Fund, choose a fundraising model that aligns with the project's objectives and risk tolerance. Market, build a community on platforms like Telegram and Discord and execute a multi-channel marketing campaign. Launch and list. Deploy the token and secure listings on relevant exchanges to provide liquidity and market access, recognizing that community backing is a key criterion. Sustain, maintain transparency, provide regular updates, and continue to build and engage the community to ensure the project's long-term viability.